It's time to face the cold, hard truth. The banking system is broken. From discriminatory lending practices to exorbitant fees, it's clear that something needs to change. But why is it that we continue to tolerate a system that seems to work against us, the customers? In this video, we'll explore some of the ways in which banking is broken and why we need to demand better from our financial institutions. So, join us in the movement for a better banking system. The banking industry is of utmost importance as it provides a safe and secure environment for people to store their surplus funds, which can then be loaned out at higher rates to individuals who require funds to bring their ideas to fruition. Although the concept has evolved to become more intricate with unconventional sources of capital and fractional reserve banking, the essence of banking remains unaltered. It is a financial intermediary that connects those with surplus funds to those who need them. Despite the criticism banks receive, they play a critical role in the economy by offering a reliable place for individuals to store their money with the assurance that it will be accessible when required. Additionally, banks offer equitable loans based on established lending parameters that have been refined over time to minimize risk. This uniformity has benefited borrowers as well, with people obtaining low interest rates on mortgages due to credit scores and other employment checks. Despite their involvement in the financial crisis of 2008 as a result of securitization, modern banking's problems go beyond this. The modern-day banking system is facing a grave challenge due to excessive consolidation, resulting in an inability to fulfill its pivotal function as a financial mediator. As a consequence, it is essential to comprehend the workings of money and understand how the last financial crisis led to the system's fundamental breakdown, which might be beyond repair. This video is made possible by this channel's members and patrons on Patreon, who are offered fantastic benefits. The banking problem started in the mid-1990s, when computers began dominating junior-level bankers' decision-making processes. Before this, getting a loan to purchase a home or start a business involved building a personal relationship with a local bank manager. The manager would scrutinize fundamental factors such as a person's job, savings, and other assets. Additionally, there was a personal aspect to the process. The manager might inquire about one's parents and use their vouch to evaluate one's creditworthiness. These aspects of banking were informal yet effective, but the banks encountered complications. Firstly, bank managers were expensive due to the extensive responsibilities associated with their lending decisions, making them highly esteemed professionals. However, the scenario has changed, and currently, a bank manager is perceived as a glorified credit card salesman. Secondly, scalability was a significant issue for the banks. Moving into a new city posed difficulties as access to basic information was limited. The evolution of technology has revolutionized the banking industry and how lending decisions are made. In the past, people with bad financial habits could easily walk into a new bank and receive a loan, leaving the bank to suffer loss when they inevitably defaulted on their payments. However, with the introduction of credit scores, the banking industry has become more sophisticated, and building a relationship with a bank is becoming less significant. Credit scores have become essential tools for banks to evaluate the creditworthiness of their clients. It is interesting to note that credit scores were not in existence before 1989, but today they have entirely replaced the role of building lender-borrower relationships. A credit score is a compilation of data points about a person's financial history, which lenders use to assess their creditworthiness. A credit score is typically determined by factors such as payment history, length of credit history, amounts owed, new credit, and types of credit used. A person's credit score is then matched with their credit file, which contains their comprehensive financial and credit history, such as credit cards, mortgages, car loans, and personal loans. Banks can easily review a person's credit file and determine their creditworthiness just by reading a number off their nationally available credit file. Notably, credit files have their own problems, as highlighted by experts. Banks have no choice but to use credit scores and credit files because of the potential benefits they offer. Today, the lending process has become simpler and more profitable due to the introduction of computers and worldwide communications. When applying for a home loan, a customer has three options: do it online, visit a bank branch, or go through a mortgage broker. If a person opts for applying online, they are required to fill out details about their income, expenditure, and other financial information. These details are then automatically analyzed and turned into data points. The data points are then sent to an assessor for review and approval or declination. Similarly, if a person applies for a loan at the bank branch or via a mortgage broker, employees of the bank or broker enter their client's information into the computer system. Ultimately, it all leads to the same outcome. The assessment happens in overseas offices, mostly located in countries like the Philippines or India, where labor is available at a low cost. By moving their operations overseas, banks save on the cost of labor, making the process simpler, faster, and more cost-efficient. While the cost savings incurred by banks due to the centralized decision-making process has positively impacted consumers in some way, it has also had a downside. In the 1990s, there were approximately 20 large banks in the US competing for market dominance. Today, there are only 4. With mergers, acquisitions, and bankruptcies over the years, major full-service banks and lending institutions have become increasingly concentrated. Big banks, to make operations uniform, prefer to leave decision-making to one piece of software than to several bank managers. This makes good sense for business and brings cost benefits. However, this approach may not be best for society in general. Banks today tend to rely heavily on the automated system and credit scores when analyzing a loan application. Unfortunately, this form of analysis may not work for everyone, as it may not consider the full picture of a person's financial circumstances. People with different income streams like tips, royalties, investment returns, rent, business profits, and government allowances, such as retired police and military personnel, may face difficulty in getting a loan, even if their credit score is perfect and they have stable savings and incomes. In the banking industry, such income streams are referred to as supplementary income, which big banks are not always keen on factoring into a loan application. The reason for this is that the automated process may not account for income types that do not produce a single big number every year. The irony is that such incomes could often be more stable and consistent than a salary, but banks will tend to be ultra-conservative when evaluating such types of incomes. In conclusion, while automation and credit scores have brought about significant improvements in the banking industry, it is essential to be aware of their limitations and seek alternatives to ensure that customers can access necessary loans, irrespective of their income type. If you experienced a significant increase in income from one year to the next due to a business venture, the major banks may not consider your increased earnings when evaluating your loan application. In fact, some banks may not accept non-traditional income sources at all, leaving individuals with no choice but to turn to lenders that have less restrictive standards but charge higher interest rates. Ironically, some of these lenders may be the same banks or subsidiaries that offer non-prime or non-conforming loans at a premium. Despite having better financial positions than regular salaried earners, many people must take out these loans to buy a home, as owning a house is a way to secure personal finances. Unfortunately, the difficulty of obtaining loans from consolidated banks is deterring many promising entrepreneurs from starting their own businesses. Unlike mortgage lending, business lending is usually complex and more expensive to process. As a result, many banks are unwilling to lend to smaller businesses, and those that do charge high interest rates to offset the assessment costs. This trend of declining non-mortgage lending over the years has had a severe impact on small businesses whose success is critical to the economy. Large corporations usually favor generic and uniform products that are easy to replicate. However, smaller businesses often rely on more unique offerings. Unfortunately, retail banking is a notoriously hard market to break into, and small banks are often acquired by larger ones. This has resulted in a lack of competition, thereby reducing the options available to consumers, particularly those with non-traditional income sources. While big banks do offer better products, accessibility, and services than smaller banks, the prospect of a major breakup could cause average consumers to lose confidence in the financial system. It would be a significant inconvenience if someone woke up to find that their Citi checking account had been transferred to a new institution because Citigroup had been broken up. Regrettably, it seems that the role of banks as financial intermediaries will continue to focus on projects that are of interest to some of the largest companies in the world. The banking system is broken, but it doesn't have to stay that way. It's time for us to demand changes and hold our financial institutions accountable for treating us fairly and providing transparent services. By coming together and demanding an overhaul of the banking system, we can create a better future for ourselves and generations to come. So let's take action and advocate for the changes we deserve. Thank you for watching. Kindly like, share, and subscribe to our channel.